So let's get into the customer accounts section. We have retirement accounts, educational accounts, accounts for minors, and joint accounts. In this section, we're going to start off with retirement accounts, and we'll talk a little bit about the two important types of retirement accounts that they cover on the SIE exam. So to start with, we have two types of retirement accounts: the defined benefit plans and the defined contribution plans. So let's get into each of these. For defined benefit plan, this is a situation where the corporation you work for may put a little bit of money into a pool or a pot, and the money that goes into that pool or pot, they are responsible for managing in terms of where they put that money, whether it's in investments in stocks or bonds, mutual funds, or what have you. So they're totally responsible. And as a result, they're also taking on a lot of risk here. They make promises to their employees when they retire as to a certain amount of money they may pay out over time. So since the employer takes the risk, you can think of this as one reason why this is a benefit to the employee, so defined benefit plans. Next up are defined contribution plans. The name helps describe what these are and how they work, because with defined contribution plans, it's up to the employee to contribute to their own retirement/savings account over time. However, some of these end up having matching programs where the employer may kick in a little money themselves. This again goes into a pool or a pot of money. But the difference in this case, as opposed to defined benefit plans, is that now the retiree is the one responsible for managing their own account and their own investments that go into that account. This is obviously risk shifted over to the employee, so as a result, they're the ones that also have the responsibility to decide how much needs to come out and when. As you can see here, the SIE exam customer accounts section on the retirement plans will touch on a little bit about the types of accounts that you'll find in defined contribution plans. So you'll see 401ks, 403bs, and profit sharing plans here. Next, we'll take a look at the other types of retirement accounts that you may be familiar with yourselves. This would be a situation where you have an individual that's saving for their retirement and they want to open other types of retirement accounts such as traditional IRAs, Roth IRAs, or simple IRAs. All of these are examples of accounts where the employee or the individual is responsible for managing their own account. So again, in these types of retirement accounts, the employee is taking on the risk, or in this case, it's just an individual. You don't actually have to be an employee to open some of these accounts. So they're taking on the risk and therefore also have to decide when to start withdrawing from those accounts and how much to withdraw over time. Within the SIE exam customer accounts section, you'll notice that defined contribution plans tends to get much more attention than defined benefit plans. And that's just because these days defined contribution plans tend to be much more common. So let's take a look at some of the characteristics of defined contribution plans. The first thing is that defined contribution plans have deferred taxable gains. Sometimes these get referred to as tax shelters, which makes it sound like some secret thing coming out of the Cayman Islands. However, deferred taxable gains are usually a characteristic of most retirement accounts. What this does is it allows investors to delay any tax liabilities that they have in the current year until later on. The obvious advantage here is that you get to use essentially the government's money in order to invest even more than you would normally get to invest. So it's kind of like borrowing. The next point is that some contribution plans, defined contribution plans, allow for tax-deductible contributions. So what this means is that accounts like 401ks, 403bs, traditional IRAs, etc., allow you to take the contribution amount that you put into those plans and actually write it off your income. So if you make $100,000 and theoretically you put in $10,000 into an account, some portion of that $10,000 you're going to be able to write off your 100,000. So let's say it's maybe five. So instead of making $100,000 and being taxed on that for the year on your salary, you're only going to be taxed on $95,000. So it's a way to try to incentivize people to save more for their own retirement and take the burden off the government. Next, we'll talk about how some of the withdrawals work. So the withdrawals are sometimes taxed and sometimes not. So this is just purely memorization. You'll just have to know the difference between which accounts are taxed when the money is withdrawn and which are not. In this case, the Roth IRA is one of the main and only ones where there are absolutely no taxes when you withdraw, whereas 401ks, 403bs, traditional IRAs, the money is taxed when you withdraw. And the important thing to know is the tax rate that gets applied is what's known as the ordinary income tax rate. So it doesn't matter if you hold it for 6 months in this account or 20 years in this account, it's never going to have the long-term capital gains tax applied to it. And that's because the government's already offered you this great benefit of deferred taxable gains. So they kind of decide at the end, we're just going to charge you whatever your ordinary income tax rate is when you withdraw. The next and last characteristic to know about defined contribution plans is whether they are qualified or non-qualified. Now, the main difference between qualified and non-qualified is the contribution going in being taxed ahead of time or whether it's pre-tax. So what we mean by this is that if it's a pre-tax contribution, that means before the taxes even come off your paycheck, there's an amount that's going to go directly into your 401k, 403b, traditional IRA, because these three also happen to be qualified accounts. Non-qualified accounts are retirement accounts where the money that you put in first gets taxed, and then the money after it's been taxed, you can decide once you get it into your bank account whether you then want to transfer it over to a Roth IRA.